Hello, everyone, and welcome to SCORE Fairfield County's live webinar on buy-sell agreements, the business advantages and funding. I'm Bob Hogan, the webinar coordinator today and a business mentor here at SCORE Fairfield County. I'll be your host today, and our presenter is Dan DeSalva. More on Dan in just a minute, but first some brief information on SCORE. SCORE is a nonprofit national partner of the SBA with over 10,000 volunteers nationally. And locally here at SCORE Fairfield County, we have over 100 volunteers with a wide range of industry, process, and subject matter expertise. And we offer three primary value-added services to small business owners. First of all, we offer free one-on-one counseling, and you can access that in person, by telephone, email, video, whatever works best for you. And you can do that by clicking on the Request a Mentor link. And if you could just advance a slide, you can see that. And secondly, we offer a wide range of educational workshops and webinars like the one today. And lastly, we offer extensive resources on our website, including access to subject matter experts. Our next live webinar will be tomorrow, Wednesday, March 12th at noon, when Joe DeGostin will be presenting on business tax planning. And again, you can find more specifics on our website, fairfieldcounty.score.org. We also have a large number of recorded webinars on our website that cover a wide range of business topics, and you can view those at any time just by clicking on on-demand webinars. Just some logistics about today's webinar. We have set aside time for some Q&A at the end of the presentation. If you have a question, please use the Q&A button at any time during the presentation, and just type in your question, and we'll take as many as we can up until the top of the hour. Our webinar will end sharply at 1 o'clock to respect your time. The session is being recorded, and a link to the recording will be available at on our website within the next day or so. It's now my pleasure to introduce our speaker today, Dan DeSalva. For nearly a decade, Dan has helped business owners utilize life insurance for their business continuation planning. Dan uses extensive industry knowledge in collaboration with advisors, attorneys, and accountants to help small business owners. He is employed by the Georgetown Financial Group and is the current president of the Western Connecticut Estate and Tax Planning Council. Dan, it's all yours.
Well, thank you very much, Bob. I appreciate that introduction. And thank you to SCORE for hosting the webinar today. Good afternoon, everybody. Again, my name is Dan DeSalva, work for the Georgetown Financial Group. Today, we're going to be talking about some buy-sell agreements. And this topic is pretty vast. I'll just start off there. A lot of rabbit holes we can go down in terms of valuation methods, in terms of specific contract language that might want to be inside of a buy-sell agreement. But I'm going to do my best to keep things high level to give you an understanding of what exactly I'm talking about and how it might implement in your specific circumstances. So really, who cares? What is it? Funding strategies, how can it be structured? And then we'll briefly talk about a Supreme Court case that happened just last year that is still having some ripple effects throughout the buy-sell industry. So that's a brief agenda for today. As far as who cares, well, hopefully if you're on this webinar, you have some interest in what's being presented. But really, buy-sell agreements often get focused on the death of a business owner. When a business owner dies, the transfer of the business interest can be a double-edged sword. On the one hand, you want to make sure that the business itself continues onward and is profitable, successful, all those good things. But on the other hand, the business owner's heirs want to make sure that they're properly compensated for the business interests. So those are certainly two parties at the table in terms of who cares. But let's just, think of some critical questions that come up when a business owner passes away. Who will purchase the business or the business interests of the owner, rather? What's a fair price? When will the sale occur? Where will the funds come from to purchase, those business interests? All of these questions are pretty substantial. And getting into the planning process after the catastrophic event of a death is not the time to really parse things out. In terms of specifically who cares, well, obviously business owners care. Um, the business entity cares. Surviving partners inside of a business want to make sure that there's agreed upon plan. Not only, for doing right by their partner, but they want the peace of mind knowing too that, you know, their heirs are going to get taken care of. Um, Sometimes it's a party that is going to be outside of the current business entity. So a third party purchaser, they're certainly going to care in terms of the buy sell agreement and what language is defined in that contract. We've talked about the heirs of the deceased, the estate out there. Most business owners, have a substantial amount of their wealth tied up in their business. So again, how do we get a liquidity event for their surviving spouses, family members, whomever, um, so they're not stuck with, shares in a business that they might not really want to run. And of course, the IRS. The IRS cares. Whenever we're talking about transferring money, um, uh, the IRS is going to have a very fine ear to that. We'll get into some of those specifics a little bit later. But in terms of just who might, be interested in buy sell planning, that's a general list there. So what am I talking about? What is a buy sell agreement? Well, plain and simply, a buy sell agreement is a legally binding contract in which one person agrees to sell to the other party, and that party agrees to buy an ownership interest in that business. The buy sell agreement should be drafted in consultation with legal counsel and tax advisors. That's a point that I really just want to emphasize, and I will be emphasizing throughout the presentation. Not only are there a lot of moving parts, but there are a lot of, seats at the table, if you will, when it comes to constructing a buy sell agreement. There's certainly, legal counsel, attorneys that would want to be present, uh, creating the language of the document that's specifically tailored to you and your business. You're going to want to work with some sort of accounting team, CPAs, in terms of getting a proper valuation of your business, financial advisors, professionals, life insurance agents, all of these other financial resources are likely going to be at the table, speaking on behalf of not only you, but your business partner. So a lot of different people at the table, but make sure really at the end of the day, you're using somebody that you're comfortable with and is vetted. So a properly drafted buy sell agreement can do a lot of things, actually. It can create a market for the business. So by defining in the contract how you want the business interests to, succeed, obviously laying out those things explicitly creates an appetite for that. Minimizes the possibility that the business might fall into the hands of outsiders. So, if you are working in a family business and you want to assure that your children take over, the buy sell agreement explicitly kind of lists the terms and starts that agreement between that generational transfer. Minimize the possibility that the parties involved will not be able to agree on a proper valuation for the business. So it puts everybody on equal footing while all parties are still alive. Again, all of those big questions that were in the previous slide, not something you want to be really hashing out in the wake of a tragedy, with one of the business owners dying. Oftentimes, the valuation method can be a little bit conflated with some emotional sentiments with the surviving heirs. Subsequently, sometimes the business partner might think the business has now depreciated a little bit because their partner's gone. So really defining in the buy sell agreement how you're going to go about that valuation is paramount. ensuring that the buyer has the necessary funds available to make the purchase of the ownership shares. So, this gets a little bit into the life insurance component. We will do a little bit of a 101 for life insurance contracts a little bit later. But for now, just, the concept of life insurance, you're paying pennies on the dollar in terms of the premium that you're paying in relationship to the death benefit, which, you know, pays out upon a death. So it's a great way, efficient way to fund these types of arrangements. We're providing the deceased owner's estate with needed liquidity. Again, going forward with the idea of life insurance, a lump sum tax-free payment happens either to the business or an individual. And then, the surviving heirs don't have those shares anymore of the business. They have, the life insurance proceeds. Orderly transfer, a lot of these kind of touch upon each other. And establishing the value of the business for estate tax purposes. That again, the IRS does audit frequently. I won't say always, but nearly always when we're dealing with transfer of these business interests. So you want to make sure it's more than just a handshake agreement. Maybe you and your business partner's heirs have a fine number in mind. That's great. But when the IRS audits, and if that valuation is different, it could result into some unintended estate tax consequences. And that's actually a pretty big component of the Connolly case, which again just got arbitrated at the Supreme Court level last year. We'll talk about that. So just to simplify things, nice little visual here. A properly written buy-sell at the very least should specify the circumstances under which the sale will occur. I've been talking about death a lot. Don't need a therapist on that, but oftentimes that is the main focus of these agreements. But they could include disability. If one of the owners were to possibly get disabled, would that be a triggering event? Divorce oftentimes is a triggering event, or even just a defined age period that they want to retire. So again, that gets back to working with an attorney. They can get you the language that's unique to you and your circumstance. Who will purchase the business? So again, just having an idea of, am I passing on my business shares to my business partner? Maybe I'm passing it down to, my children. They're going to come into the business. Maybe we're going to look for an outside third party. Again, it's great to have that pinned down in an efficient buy-sell agreement. And just language to the valuation method that's going to be used at the time of the sale. That valuation method could do a whole nother webinar. You want a CPA or an accountant for that. There's a lot of different ways a business can be valued, and that's unique to each specific industry. So won't get into that, but it's important to have that considered when constructing the buy-sell agreement. All right, so some more visuals here, so I'm not just reading off a screen. Elaine and Bob own an ice cream store, an ice cream cone store, let's say. They look thrilled about it. Despite their frowns, business is good. Elaine and Bob are really profitable, having a successful ice cream cone business. And then Bob walks in front of the proverbial bus and is no longer. So, without a buy-sell in this scenario, Elaine is going to have to work with Megan, Bob's grieving widow here. It's fun to find this clip art. But, it's not hard to envision some of the problems that could occur if there was no properly worded and agreed upon buy-sell agreement. Maybe Megan is resentful of the company that Bob spent so much time for. And she feels like, the value is 5 times what Elaine actually knows is what it's worth. Well, Megan says Bob was always working on the weekends. He was out there slinging ice cream cones. So, I want 2 times what you're offering for Bob's shares. Or, maybe Megan and Elaine just don't get along. There was a dinner party incident a few years ago, and now it's just, oil and water. So, a lot of different ways you can kind of spin out of the hypotheticals here. Maybe Megan doesn't even know anything about ice cream cones. She's lactose intolerant, so she wants no part of the business. Well, all of a sudden she's got Bob's shares, and again, without that properly worded, constructed buy-sell agreement, all of these issues are on the table at the worst time. Megan's grieving, Elaine's trying to navigate the business. And that's really the value of a buy sell agreement, defining those things prior to the event. So I will just kind of throw up a little caution sign. Always use a properly licensed professional when drafting the buy sell agreement. Again, I'm going to come back to this theme. A lot of people at the table when these arrangements are happening. So make sure that you're vetting the source and the professional that you're using. So from 1,000 feet up, that's what I'm talking about when I'm talking about a buy-sell agreement. Again, defining those succession points for the surviving business partner and how you want your shares to be bought out. Let's talk a little bit about funding options for buy-sell agreements. I mentioned at the top that life insurance is a common funding method for these buy-sell agreements. In life insurance, as a tool for this specific contract, is pretty valuable. As long as premiums are paid and there's no significant loans or withdrawals or anything on the policy, there will be a liquidity event upon a business owner's passing to immediately fund the buy-sell agreement, which again is a separate contract to the life insurance contract. But the buy-sell contractually obligates, the business or the owner, however it's structured, to use those life insurance proceeds to fund the buy-sell agreement and buy out the surviving heirs. So you're never gonna, from a ratio premium to death benefit, oftentimes life insurance makes sense, but there are circumstances where that's not available for everybody. Maybe you're dealing with some insurability issues, maybe old age, whatever that might be, then you could look at setting aside a sinking fund. That could be something at the bank, that could be utilizing some investments with your financial team. But ultimately, the concept from a high level is, hey, I'm going to put aside some money, rainy day money, just God forbid, one of the partners passes away, and we're going to be dealing with some of this turbulence. Again, if you go the sinking fund route, the specific language should be hashed out in the buy-sell agreement. The more specific you can get in that agreement, the better. If it's really just something that, well, when we have some extra money lying around here, we're going to throw it over to the fence. Works for some people, but not the most efficient, I would say. And then installment sale, that's a little bit more of similar concept, but after death. So you're buying chunks of the business prior to the death, but then that sale is really solidified once that business owner passes away. Just keep in mind with the sinking fund installment sales, you're using some earnings of the business theoretically. So that's why many people opt to go with the life insurance route, just for the sake of efficiency. So let's talk a little bit of life insurance. Everybody's favorite topic, I'm sure. But it is important to at least have a very cursory understanding how insurance companies work, how a life insurance policy works when we're talking about using it as a tool to fund buy-sell agreements. So life insurance 101, at its most basic, a large group of people pay a premium to an insurance company. That insurance company is, not only collecting premiums from thousands, if not millions of other people, but, taking those paid premiums and typically investing it in pretty conservative investment, uh, you know, bond funds, things like that. Ultimately, between the premium payments and the general account returns at the insurance company, there is a pool of funds ready to cover a certain risk. So, you know, just for the sake of this slide, one out of every 100 people paying into that premium, paying into that life insurance contract unique to them, maybe one out of every 100 people in that pool passes away this year. So the insurance company only has to, provide that death benefit for one, and then the other 99 are still contributing and paying premiums. Um, Life insurance, there is some consideration on the part of the insurer. There will be some medical underwriting, um, depending on your age, your health history, things like that. It depends on how invasive that underwriting will be, but it is a unique tool. Just wanting it and just having the liquidity to pay for it is not enough. The insurance company has to do some due diligence on their end and make sure they want to take on that risk. Generally, always there are three parties to the life insurance contract: the owner, the insured, the beneficiary. When constructing uh, these uh, categories are going to be important when we talk about structuring life insurance to fund buy-sell agreements. And in general, it's important to understand that, out of these three parties, two of them must be the same person. Um, Not going to drag you through the tax law and everything like that, but basically you want to make sure that there's three parties, but two of them are the same person or the same entity. Types of insurance, again, could be a whole other webinar, but just from a very high level, there's some temporary coverage, so level term or annual renewable term. Those types of contracts are purely protection focused. They're only offering a death benefit. Think of it as, any other bill you would get in the mail. You pay the premium, the death benefit's there if you need it. If you don't need it and that defined term period expires, then the coverage just evaporates. There's no liquidity, there's no living benefits. It's really just a proposition of death benefit. And as you might imagine, that those temporary contracts, those level terms, and those annual renewable terms are the cheapest when it comes to, premium to death benefit ratio. Then there are permanent life insurance policies. Those are things like whole life, universal life. There's a million other kind of offshoots of universal life, index universal life, and what have you. The two main differences with the permanent life insurance: one, these policies are meant to be there for when you die, not if you die. So, longer term focus, but also they provide typically some living benefits, which could include some cash value components. So there is liquidity growing inside the contracts. And that could be attractive when doing some buy sell planning, uh, to effectively give yourself, or give the business rather, an account that it has access to. I won't go through all the tax points here, but just the savviness that a life insurance policy has, tax savviness, I should say. Most people are familiar with that first IRS section 101A. Death benefits are tax-free. When again constructed properly, you want to make sure that two parties are the same people out of those three parties: owner, insured, and beneficiary. But it's a nice way to get immediate tax-free lump sum when doing some of this protection planning for buy-sell agreements. You know, there's other benefits here. The cash value that grows inside of a life insurance policy is not taxed each year that it accrues. And then, depending on how you access that cash value through strategic loans and distributions, you could avoid some tax there as well. And there's no penalty in terms of early distribution prior to 95 and a half, like there is for a lot of other qualified accounts. So, the value of cash value life insurance, is written in the tax code. A lot of the times when we're talking about buy sell funding, people immediately turn to term insurance just because, again, from the price standpoint, it's the most lean. But the only value you're getting in a term life insurance policy is that death benefit protection. With some permanent life insurance and cash value, there's a little bit more flexibility and a lot more potential value. Um, so why do businesses purchase life insurance? Succession planning, like we're talking about, there's an immediate trigger event, makes the buy sell planning kind of self-fulfilling with the death of a business owner. But there's other components that can be utilized too with life insurance and business owned life insurance. Key person coverage. So it's a little bit different than buy sell, but imagine you have an associate, somebody inside of your business that is really responsible for making things go. Maybe they're your rainmaker, they're your salesperson. If they were to get hit by the proverbial bus, your business would suffer economic loss. Getting a policy on that person might make sense. And, a lot of the times those cash value life insurance policies can be leveraged not only from the protection focus, but used as a reward, if you will, to retain some employees. Life insurance is, unique in terms of how it can be deployed in the business market. It doesn't have to comply with some of the ERISA standards, so you could selectively choose which employees you want to potentially give this benefit to without having to offer it to your whole rank and file. So again, just another warning here, always use a properly licensed professional when securing a life insurance policy. There are a lot of insurance agents out there. I'm sure people know somebody, whether it's a brother-in-law or a neighbor. Just make sure whoever you're working with, there's that trust there, and that you're doing your due diligence when leveraging their services for something as comprehensive as buy-sell agreements. Okay, so we've kind of talked about what is a buy-sell agreement. We talked about how life insurance can be a very efficient tool to fund those policies. Let's talk a little bit about structuring the life insurance policy in those scenarios where you do have the death benefit proceeds, self-fulfilling the buy-sell agreement. The two main structures here are entity purchase and cross purchase. Again, I'm just trying to keep things high level. That is the majority of business structuring that we see out there, but there are other offshoots, and you can get more specific to your industries. But from a concept standpoint, I think it's important to cover both of these. So a little busy of a slide, I do apologize, but there's the entity purchase arrangement, which it's kind of what it sounds like. The business itself is purchasing a life insurance policy on each of the owners. So here, as the slide shows, three silhouettes, there's three business owners, there's going to be three different policies that the business owns on each one to fulfill that buy-sell agreement. So, the granular text here, make sure it's very important, when a business is taking out a policy on an owner, or on anybody really, it's really important that the proper disclosures and notices are 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 are, are done correctly. Um, so there have been cases in the past where companies were abusing this corporate-owned life insurance. Stranger-owned life insurance is a concept that some of you might have heard out there. There's been regulation instituted to curtail that. And a big thing is, properly disclosing to all the individuals that you're obtaining a life insurance policy on. And that's, not only at the front of the implementation, securing that policy, but also each year that you perform, that you complete your taxes, there's going to be some attestation and a really quick tax form. But again, a lot of moving parts to this type of planning. Okay, so you secure a policy on all business owners. What happens, when one of them dies? Well, the buy-sell agreement, the the document that you've worked on with an attorney, and likely a CPA, is going to define how the life insurance proceeds are going to be distributed to the heirs. Um, Functionally, the life insurance contract is going to pay out to the business. So again, the business owns it, the business is a beneficiary, the owner is the insured. So three different parties, two are the same. Business is the owner, business is a beneficiary. Once the business has that tax-free lump sum death benefit, they're going to, fund the buy-sell agreement and, fulfill the obligations that all business owners have agreed upon with that life insurance proceeds. So, the heir, the surviving spouse often, will have those business interests, and the company comes in, executes the buy-sell agreement, and buys those shares back from the surviving spouse. So a little bit of a busy slide here, but let's talk about some pros and cons of the entity purchase. So, pro, relatively easy to implement, especially when there's a high number of partners or business owners we're dealing with. Again, with the business owning the policies, it's really just how many owners are we talking. If it's four, then we need four policies. If it's two, then we need two policies. Pretty straightforward. As far another pro, business has access to the life insurance cash value. If being funded by permanent life insurance, we talked about some of the ways that those cash value life insurance policies can be positioned as a benefit to the business, maybe help retain certain employees. So as another account effectively out there, grows tax free and can be accessed strategically in a tax favorable nature. Pro reduces the financial strains on the individual owners. Again, the company's paying for it. It's not coming out of the owner's pockets in terms of the premium. Cons, potential concerns with the business value increase post Connolly. We'll talk about Connolly in just a few minutes. But in the wake of the Supreme Court decision last year, an entity purchase has lost some of its shine in certain spheres. With that, potential concerns with surviving partners' estate tax increasing because of the Connolly case. And ultimately, one of the bigger cons for the entity purchase is there's no step up in basis for the surviving owners. The shares of the deceased are simply dissolved, or are oftentimes dissolved within the company. And let's run another visual here. Bob and Elaine already not looking too happy. Maybe they have ESP. They know what's about to happen. Bob gets hit by the proverbial bus. For this example, let's break out their shares. They own the company 50-50. Elaine has 500 shares. Bob has 500 shares. Well, Bob no longer has 500 shares. Um, and what's happening here, and an entity purchase, the life insurance proceeds are going to go to the business. So, that's a skyscraper right there selling ice cream cones. And then the entity, the business, is going to pay out the life insurance proceeds to Bob's widow, Megan, I believe her name was. And Megan's transferring her shares back to the entity, and the entity is absorbing those shares. So if you notice, Elaine's shares here remain the same. She still has 500 shares, but her ownership percentage obviously went to 100%. So in this scenario, again, with just the way the buy sell is structured with that entity purchase, the business is absorbing those shares that Megan, sold to them, and they're retiring. So let's talk about a slightly different way to structure things. Cross purchase. Again, a busy slide here, but try to stick with me. Instead of the business entity owning the policy on each owner is actually going to own a policy on a corresponding owner. So if you have two owners, that makes things really easy. Owner A, owner B. A owns a policy on B, B owns a policy on A. A and B are not only the owners of the policies, but the beneficiaries of the policies as well. And in the event of one of the business owners passing, um, the business owner, the surviving business owner, is directly receiving the tax-free lump sum from the life insurance company. Uh, the surviving owner will then, execute the buy-sell agreement by going to the surviving heirs, the, deceased owner's estate, buying out the shares with the life insurance proceeds that they just acquired. And then, moving forward, they're still 100% owner of the business, and the surviving heirs have been taken care of. Uh, So some pros and cons to this cross purchase arrangement. Pros, offers a potential step up in basis for the surviving business owner. We'll run through an example just in a minute, but you know the shares aren't being dissolved, unlike the entity purchase here. Rather, the surviving business owner is purchasing them. Um, Keeps the death benefit proceeds from potentially inflating the business evaluation. Again, that's a note specifically tied to the Connolly case. We will get to that. Um, and then, direct ownership of each policy just gives each owner potentially a little bit more control. So there's no, business entity that they have to run things by. I own the policy on my partner, they own the policy on me. If we want to arrange some sort of transfer once, we're out of the business or things like that, that can be a little bit more easy, for lack of a better word. Cons. Well, if you have more than two business owners, it can be pretty difficult because unlike the entity purchase where the company is buying a policy for each owner, on a cross purchase, each owner is buying a policy on every other owner. So if you have three business owners here, business owner A is going to have to own a policy on business owner B and C. B is going to have to do A and C. C is going to do B and A. If you have 4 or 5, you can just see how it daisy chains. There's a lot of different policies that will be required. So that can be, a big con when you're talking about business ownership that's more than 2 or 3 people. The individual business owners ultimately are the ones responsible for financing and managing the policies. Again, as the owner of the life insurance contract, the business owner is going to be the one, required to pay premiums on an annual, monthly, quarterly basis, whatever they decide. And if they do opt for a permanent policy with some cash value features, it's going to be on the business owner to review that policy, make sure it's performing appropriately, make sure it's doing the things that it was intended to do. So just more kind of onus on the business owner as the contract owner. And finally, in that vein, there's a potential uneven financial burden between the business owners. If, age is often kind of the prime example. If somebody is older, the cost of their insurance is likely to be higher than somebody who's younger. Not only, from the mortality standpoint, or any health conditions that they might be dealing with. As you get older, you tend to deal with more health issues. But just from an actuarial standpoint, the older you are, the closer you are to life expectancy. So the cost of the insurance is going to be greater than, somebody 20 years younger than that owner. But again, things like smoker status, if somebody, smokes tobacco, marijuana, that could increase, that will likely increase their premium rates versus somebody who doesn't. Underlying health issues, all of that stuff. So there could be some unevenness. And when you're paying for it out of pocket, you feel it a little bit more. All right, so Elaine and Bob, I'm so sorry to do this, Bob, but Bob walks into traffic again. Bob, accidentally. Elaine is upset. Here, we specified out the 500 shares here. Let's look at what happened in a cross purchase agreement. So you got Megan, the surviving spouse, the widow here. So upon Bob's death, his 500 shares gets transferred to her. That's, his surviving spouse. She's, gets his surviving estate. She gets the 500 shares. Well, in a cross purchase, Megan's going to get the death benefit proceeds from the contract that she had on Bob. Now, Megan herself is directly going to go buy out, Elaine is going to get the death benefit proceeds from the contract that she had on Bob. Elaine is going to take that lump sum death benefit and go personally buy out Megan and her shares. So Megan's 500 shares don't get absorbed, but they actually get sold to Elaine. So when I talked previously about a step up in basis, now Elaine has already purchased 500 shares. If Elaine goes on 5-10 years from now to sell the company, her cost basis now accounts for those shares that she already purchased. So, another benefit to a cross purchase agreement, the surviving owner here would get that step up in basis and could potentially reduce taxable burden at the time they ultimately do sell the company, to a third party. All right, I've been teasing it this whole time. The Connolly case versus the United States. Let's get into it. Nothing like talking Supreme Court law near lunchtime. So what exactly happened here? Well, this case was surrounding two brothers. They owned a C Corp, a building material company, and they decided to go with an entity purchase buy-sell agreement. So there's a lot of asterisks all over this Supreme Court case. And for anybody on the call who, is in the legal realm, I'm sure you can appreciate that really navigating the waters a year out. It's a lot of this stuff is still rippling. But here are the specifics of the case. The entity buy-sell agreement stated that every year that they would have the valuation determined by mutual consent. They never did that. They never followed that provision of the buy-sell. And if an owner died and there was no mutually consented value, the value would be the average of two qualified appraisals. Spoiler, they didn't do that either. But what they did do is they bought two life insurance policies on each other, or rather the business did as an entity purchase, and each got $3.5 million of life insurance. Well, unfortunately, Michael died in 2013. So the $3.5 million got absorbed by his company. Well, what happened after he died? Well, there was no appraisals of the business that were retained. And Thomas, the surviving brother, negotiated a sale with Michael's son on the basis of an agreed upon value. So uncle, nephew, they kind of worked it out to the side. You know, not bad, but kind of not following any of the rules that were laid out in the buy-sell agreement. So, the value of the C Corp goes to Mike. The value of the C Corp shares gets absorbed into Michael's estate as that agreed upon value. Michael's estate files her tax returns. They think, okay, we're all done here. Everything is hunky dory. Enter the IRS. The IRS audited. They weren't too pleased that the buy-sell agreement was kind of an afterthought in all of this. But specifically, one major piece really shook out of this case. And again, it started off in lower courts. It kept on getting kicked up to higher courts. Finally, last year, it was heard by the Supreme Court, and the Supreme Court agreed with all the lower rulings. And really, what does all this mean in terms of the context of the buy-sell discussion? Well, that $3.5 million of the life insurance proceeds that was paid out to the company, the IRS argued, well, you just got an influx of $3.5 million tax-free. Your company isn't worth, let's say, $3 million anymore. Your company's now worth $6.5 million. Well, the Connolly case, the defense was, no. The buy-sell agreement is dog-earing these funds. We have an obligation to take that life insurance proceeds and pay out the surviving spouse or the surviving heirs at Michael's son at this point. But again, not going to get caught in the minutia of the legal proceedings. Ultimately, that was not how the Supreme Court saw it. They sided with the IRS. So, the landscape now is an entity purchase could increase that value based off of the life insurance death benefit that's absorbed through the buy-sell planning. It doesn't matter that the buy-sell explicitly states we're going to take the life insurance proceeds and pay them out. The IRS, in this specific instance, viewed that lump sum exchange, the lump sum death benefit as increasing the overall business, and that has estate tax ramifications for the surviving heir, and obviously has implications in terms of the payout of the insurance. So, real quick, we're almost at the end of this here. I had to bring Bob and Elaine back here. This is the last time, Bob. Stop listening to your AirPods while crossing the street. Gets hit by that proverbial bus. But this time, let's break it down. Let's say they had an entity purchase. So Bob has $5 million of life insurance. Elaine has $5 million of life insurance. By just that rough, evaluation, they're saying their company's worth $10 million. Well, in an entity purchase, the $5 million gets paid to the company. And now the company, in the wake of the Connolly decision, is not worth $10 million anymore. It's immediately worth $15 million. So this can provide some problems, as you can imagine, depending on how that buy-sell document is worded. In terms of buying the shares or paying out his heirs or his spouse here, surviving spouse. If the buy-sell agreement specifically stated we're going to use the $5 million to pay out, and that's the agreement we have. Okay, great. But now Megan is left with a $7.5 million estate evaluation of what those shares were. And that could lead to some estate tax issues, depending on her overall financial picture. If the buy-sell agreement doesn't define a dollar amount, but it says something along the lines that, 50% of whatever the valuation is upon one of the owners passing is what's going to get paid on to the surviving spouse. Well, all of a sudden, we need $7.5 million coming from the company, not the $5 million that the life insurance paid out. So, moving forward, navigating the buy-sell agreements, think about, is an entity purchase really the best thing for your group, for your business? Again, if there's multiple business owners, it definitely has a way, its pros. There are ways to do entity purchases, with potentially avoiding those tax implications. It's a little bit more involved. And if you do have a policy, please review it, because again, this court ruling was just last year, not even a full year, last summer. So you very well might be sitting on an estate tax issue and not know it. All right, wrap it up. You've worked hard to build your business. Take the time to protect its future and those who depend on it. You do that in part by, getting a buy-sell agreement together. Buy-sell agreement should define those three things: what constitutes the sale, in what circumstances, who will purchase the business, and then kind of an idea of what valuation method is going to be used at the time of the sale. We talked about life insurance and how it's a common tool to fund these policies. Talked about cross-purchase agreements, entity purchase agreements, who's the premium payer, owner, and beneficiary. That's on the screen right now. And again, just one final emphasis: work with qualified professionals as you go through this process. Attorneys, CPAs, financial advisors, insurance brokers, review the plans that you already might have in place, because they might be a little bit outdated, not only in the wake of the Connolly decision, but just, life happens, situations update, and it's important to deal with that now than rather on the other side of a death. So, that's my time here. I appreciate everybody's attention. I'll shut up and take some questions.
All right, thanks, Dan. We'll now use the remaining time for Q&A, and we'll take as many as we can up until the top of the hour. Please, if you have a question, use the Q&A feature that's at the bottom of your screen, and we'll just, as I say, take as many as we can. The first one here is from Jorg. Do you have any advice on collaborating with companies that haven't signed NDAs yet? New versions of advanced software technologies will impact value creation strategies that will improve infrastructure and effectiveness standards of professional development in respective industries / market creative platforms. So not sure how that relates to buy sell, but
yeah, I mean, again, I just go back to the, work with a qualified attorney. That sounds like, something under their purview. The nature of this planning can be a little bit elusive, oftentimes questioned, and maybe that's lined up here. How do I know the valuation of my business? How do I know the right amount of life insurance to get? Isn't the value of my business whatever anybody's going to pay for it down the road? There are nuances here, but any planning at the end of the day is better than no planning. So again, talk to an attorney about that specific issue.
Next, we did have a couple in the chat related to the business. One was, what are the tax related implications for the business, and then clarifying whether the life insurance premiums are deductible for business owners. So maybe you can just clarify that whole tax situation.
Yeah, great question. When we're talking entity purchases and the businesses own the policies outright, those premiums are not deductible. The deductibility of the life insurance is really at a low threshold. So I think it's 50,000 off the top of my head. So most of the time, the policies that are being implemented for this type of planning is well beyond that dollar amount. So, it's important not to deduct those premium expenses. And if they have been deducted, it could result into the death benefit being received with some tax rather than tax free.
I think that's helpful. One more here, again, not directly related to buy sell, but it's from Jorg. How can we hold the Federal Insurance Office / Oversight Council accountable for not adhering to Dodd-Frank laws or regulators not able to properly protect consumers against fraud, abuse, or scams resulting from companies selling end user data without consent and violating emerging ethical marketplace rules and laws? So again,
I mean, that's a big question.
Yeah.
The insurance marketplace, when we're talking just squarely life insurance, is not something that has federal oversight. It is run on a state by state basis. The rules and the regulations in one state could be completely different than another. We're right next to New York. I'm sure a lot of us do business in New York. The product landscape, the compliance landscape, it's vastly different, once you cross over 95. So, I, I'm not, I agree that there has been some, nefarious, things going on from a large end, but, from a federal oversight, it's not really there in the life insurance. It's run on a state regulated basis. So, um, give you a little insight there. I'm sure that doesn't address the heart of the question, but it's a little context.
Okay. One last question just come in from JA. How does a buy-sell agreement differ if it's introduced at the time of forming the partnership or after the partnership is established? What are those pros and cons?
Um, Good question. Just so a buy-sell agreement as a document can always be amended. In fact, right now I'm working with a company who is amending their buy-sell agreement given the Connolly decision. They had an entity purchase, so they want to move that to a cross purchase, not only for the step up in basis, but also, for to skirt the potential estate tax issues with the company getting that additional valuation. So, buy-sell agreements are great to have in place. They're not something that are set in stone. They can always be amended and revised, depending on, the tax landscape and also, your specific circumstances. So, getting it done on the front end while the business is forming, I think just from a functions, as ease of doing business kind of gets everybody. You already have your team together. You're already working on so many things. So maybe it makes sense to do it then. But just if you do, just don't worry that it's set in stone. You can always go back, revise it, amend it later.
One last quick one from Kenny. My accountant suggested a buy-sell. My attorney suggests a trust will. This is for a family business, retired father, mother, son operating the business. Would a buy-sell override a trust will?
Yeah, great question. And this is again, work with the properly qualified individuals. I'm not an attorney, but when you think about the structure of a life insurance funded buy sell, you know, trust planning can get complicated when you try to kind of overlap those things because oftentimes the nature of a trust is to get that those assets out of an estate. So really what we're looking to leverage with the life insurance funded buy sell is a liquidity event. So if the funds ultimately siphon off to a trust, it can be difficult Not saying impossible, but it can be difficult to get those funds from the trust to, buy out the surviving partner's heirs. So, or so the deceased partner's heirs. So, work with an attorney on that one. But sometimes, it's best to have one specific insurance contract addressing the buy sell, another more for the estate planning with the trusts.
Unfortunately, that's all the time we have for questions. Just a reminder to everyone that the webinar has been recorded and it will be available the next day or so on our website under recorded webinars. And our next live webinar will be tomorrow, Wednesday, March 12th at noon, when Joe DeGostin will be presenting on business tax planning. And again, the specifics are on our website. Again, if you want to take advantage of the free individual counseling, you can use the yellow bit.ly link that you see there on the screen. And we'd also appreciate if you could fill out your evaluation for today's webinar. They are very helpful to us. And on behalf of SCORE, thank you all for attending today's live webinar. And a special thank you to Dan for presenting today. And enjoy the rest of your day, everyone. Thanks, Dan.
No problem. Have a good one.